I think the gold price in the last 18 months, well, really the last 24 months, is really indicative of the fact that the reckoning is really and truly upon us. Let's look at it arithmetically. The on-balance sheet liabilities of the U.S. government, and I'm not going to talk about other economies, which are in mostly worse shape, but the on-balance sheet of the U.S. liabilities, of the U.S. federal government, not state and local government, exceed $37 trillion. And that's the number that the naysayers focus on. But the truth is worse. I would suggest that gold's march began in the year 2000. Not in 2022 or 2023. Remember that 25 years ago, gold was at $250 an ounce. Gold has increased at 9% compounded for 25 years, which is to say that gold, at least in nominal terms, has done its job.
Tonight, we bring you the powerful insights of legendary resource investor Rick Rule, a man who has spent nearly 5 decades studying cycles of debt, inflation, and the inevitable return of real money. In his latest interview, Rule doesn't mince words. The reckoning is here. Gold's explosive rise, he says, is not a speculative rally. It's the mathematics.
This is mixed. I'm referring in particular to the U.S. economy. There's some self-inflicted wounds, of course, around tariffs. The underlying economy is not bad. It is, in fact, good for people who have really, truly marketable skills. Unfortunately, a lot of American society doesn't have marketable skills. The softness we're seeing in certain commodities, in particular oil and gas, suggests that the overall economy is not as strong as people would have it. And it's been a very long time since we had a recession. This is not a call because I'm not an economist. I would merely state that one would expect the oil and the gas price to be higher relative to production plateaus in the U.S. were the overall economy strong. I note, too, that despite the relative strength in the U.S. economy, that there's a lot of political pressure in the United States to cut interest rates, which is an odd thing to do with CPI stated inflation fairly stout, and the overall economy is very strong. It speaks to the politicization of the U.S. economy. And I think that this inflation and this politicization on top of the debt and deficits experienced in the U.S. and in other countries is an easy way to explain and an accurate way to explain the incredible strength that we've seen in the gold and gold equities markets this year. I think the gold price in the last 18 months, well, really the last 24 months, is really indicative of the fact that the reckoning is really and truly upon us. Let's look at it arithmetically. The on-balance sheet liabilities of the U.S. government, of the U.S. federal government, not state and local government, exceed $37 trillion. And that's the number that the naysayers focus on. But the truth is worse. The off-balance sheet liabilities of the U.S. government, represented by entitlements, Medicare, Medicaid, Social Security, federal pensions, military pensions, that number is estimated by the Congressional Budget Office at $120 trillion. Now, to put that $120 trillion in perspective, gross federal income at the United States, revenue into the federal government from all sources, before they do anything like pay salaries or bomb foreign countries or whatever it is they do, is only $5 trillion. So you're trying to satisfy an obligation with a net present value, not a nominal value, a net present value of $120 trillion on gross income of $5 trillion before other expenditures. That doesn't work. There's 2 ways out for the United States. One would be an honest default, which is where you say to the bondholders, yes, we realize we owe you $37 trillion, but we don't have it. And you say to the Medicare and Medicaid recipients, the Social Security recipients, say some old codger like Rick Rule, yeah, you paid in for 60 years, that's right, we understand, but there's no money, so we're going to renege on part of our promises. That honest default isn't going to happen. We're in the midst of a dishonest default, where we honor the nominal value of our obligations to our bondholders and to entitlement recipients, but we inflate away the net present value. My belief is that over the next 10 years, in an absolute sense, the US dollar will lose 75% of its purchasing power. Not in a relative sense. I don't think that the US dollar will do badly against the pound, against the sterling, against the Canadian dollar, against the Australian dollar. Countries that have the same circumstance, but maybe less resilience than the United States. But I do believe that in an absolute sense, the US dollar loses 75% of its purchasing power. That's a consequence of the fact that we've lived beyond our means for 40 or 45 years. The gold price, I think, is a reflection of that. I'm not certain that the gold price, which has risen in nominal terms from $253 an ounce in the year 2000 to some number exceeding $3,700 today, I'm not certain in a real sense that the gold price is up at all, but in a nominal sense in US dollars is up 9% compounded. I would suggest to you that as a consequence of our society living beyond its means, that the increase in the gold price represents the deterioration in the purchasing power of the US dollar, represented by the deterioration in confidence that US and foreign savers have in the integrity of the US dollar. If people ask me what would cause me to sell my gold, I say a cessation of the problem. If I saw some chance of a balanced budget in the US, by the way, the budget is in excess of $2 trillion in deficit today, or if I saw the ability for a political resolution of the entitlement liability, or if I saw positive real interest rates in the United States. By positive real interest rates, I mean an interest rate on the U.S. 10-year Treasury that was in excess of the rate of the deterioration of the purchasing power of the U.S. dollar, then I'd sell my gold. I believe that while the official statistics around inflation, the CPI, suggests that inflation as defined by the US government is running by 2.9% a year. Inflation defined as the deterioration in the purchasing power of the US dollar relative to the basket of goods and services acquired by US families. By that definition, I would suggest to you that the purchasing power of the US dollar is declining at about 8% compounded. A real interest rate, then, would mean that the U.S. 10-year Treasury would have to yield some number in excess of the rate of deterioration of the U.S. dollar. The U.S. 10-year Treasury right now yields about 4.5. In the circumstance that would cause me to sell gold, the U.S. 10-year Treasury would have to be yielding 10 or 10.2 or 10.5, a circumstance that I don't think will occur. I think as a consequence of negative real interest rates, on-balance sheet liabilities and off-balance sheet liabilities, and the need to print to honor the nominal, not real value of those obligations. That
Political reflection of a government and a currency living far beyond their means. Over the last 24 months, gold has surged from roughly $2,000 to above $3,700, compounding at nearly 9% per year since 2000. That means over a 25-year period. Gold has outperformed most asset classes. It's doing exactly what it was meant to do: preserve purchasing power while fiat currencies deteriorate. Silver, too, has climbed in tandem as investors rush to tangible assets amid an accelerating loss of trust in the U.S. financial system. Rule begins by laying out the hard arithmetic behind the crisis. America's on-balance sheet federal debt now exceeds $37 trillion. But that's only the beginning. The real catastrophe, he warns, lies in the $120 trillion of off-balance sheet obligations, promises embedded in Social Security, Medicare, Medicaid, and federal pensions. These liabilities dwarf the U.S. government's annual revenue of just $5 trillion, leaving what Rule calls a fiscal equation that simply does not compute. According to Rule, there are only two ways out: an honest default or a dishonest one. The honest route, admitting the government can't pay what it owes, is politically impossible. The chosen route is inflation, a dishonest default, where debts are repaid in dollars worth far less than those borrowed. In
5 years. That's going to require a ton of copper, metaphorically, many tons of copper. Copper for generation, copper for transmission, copper once the wire reaches the home for utilization. Copper demand is insured for a very long time, and copper supply will be short, irrespective of the gold price. The impact of inflation on copper needs to be considered too. We are going to have to build a lot of copper mines in the next 15 years. And the cost of developing those copper mines, at least in nominal US dollar terms, isn't going to go up, it's going to explode. What is today a $7 billion or $8 billion upfront capital expense to build a South American porphyry is going to become in very short order a 10 or 12 or $14 billion upfront capital expense. That means that existing long-lived producing assets are worth much more than people think they are, because you obviate the necessity of the upfront capital cost. We in the United States dealt with it at the end of the decade of the 1970s. We allowed the interest rate to rise to market levels, which is to say 18%, which broke inflationary expectations, broke a lot of people too. And while we didn't reduce the size of government, we reduced the rate at which government increased. The Reagan Revolution, despite its sort of vaunted anti-government stance, was derailed by politics. We didn't reduce the size of government at all, but we reduced the rate of growth of the US government in the period 1980 to 1992 fairly dramatically. That allowed the economy to grow at a pace that was more able to afford our collective stupidity. And I suspect what happens in the next 10 years is not dissimilar to what happened then. I expect ultimately that the market will get in control of the long-term interest rate, not the Fed. That'll have fairly profound implications in terms of the cost of capital. And I believe that 10 years from now, I hope, we will slow the rate of growth in government expenditures and hence government debt. I think with regards to entitlements, that we will reform entitlements. I think as an example with Social Security, they'll say to some fat old rich guy, Rick Rule, the idea that your taxation for Social Security ends at $160,000 income is going to go away. You're going to have to pay in just like everybody else at all levels of income. In other words, there's going to be a huge tax increase for productive shareholders, productive taxpayers. The second thing that happens is they're going to look at me and they're going to say, no matter how much you put in, we're going to means test it because we can't afford to pay you. So there's going to be a straight transfer in Social Security where they steal money from folks like me in terms of how much they tax, and they don't pay them anything. That's called theft. That's going to happen. The other thing that's going to happen, and it should...
Simple terms, the Federal Reserve will print its way out, and the cost will be a 75% loss in the dollar's purchasing power over the next decade. He argues that this is already happening. Inflation, as officially reported by the government, sits near 3%. Odd. But in real terms, measured by the decline in what American families can actually buy, it's closer to 8% per year. That means the so-called safe 10-year Treasury yield 4.5% is in fact locking in a negative real return of roughly minus 3.5%. That's why I own gold, Rule says. And I'll sell it only when we see balanced budgets, real positive interest rates, and a reversal of monetary dishonesty, conditions that are nowhere in sight. This monetary breakdown, he adds, is why gold's recent performance should not surprise anyone. From $250 an ounce in 2000 to nearly $4,000 today. Gold's steady climb has simply mirrored the dollar's long-term erosion. Gold isn't rising, Rule says. It's the dollar that's falling. And the story extends far beyond precious metals. Rick Rule, known for his deep involvement in the mining and energy sectors, sees copper as the next major play, not as a speculation, but as a structural necessity. The world, he says, has underinvested in copper exploration and development for over 30 years. And with electrification, artificial intelligence, and renewable energy expansion, the global need for copper will soar. 1 billion people still lack electricity. And as developing nations build out infrastructure, they'll need copper for generation, for transmission, and for every wire that connects to the home. Meanwhile, the cost to build a major copper mine, once $7 or $8 billion, is now heading toward $12 to $14 billion. Thanks to inflation and environmental restrictions, that means existing producers are sitting on assets worth far more than the market realizes. Turning back to macroeconomics, Rule warns that the United States is repeating the mistakes of the 1970s, a period that ended only when interest rates were allowed to rise to 18% under Paul Volcker. But he doubts modern politicians have the courage to do the same. The market, he predicts, will eventually set interest rates, not the Fed. When that happens, the cost of capital will explode, forcing reforms on government spending and entitlements. Social Security, for instance, will likely see higher payroll taxes, reduced benefits for the wealthy, and a higher retirement age. Perhaps 70 or 72. That's not a policy choice, he says. It's arithmetic, America's entitlement structure. built for a population with a life expectancy of 66, simply cannot support retirees living into their 80s. As these fiscal pressures mount, investors are abandoning paper promises for real assets. The dollar's credibility is weakening globally, while gold and copper are reclaiming their roles as the foundation of value. Central banks, particularly those in emerging markets, are buying gold at record levels, a silent vote of no confidence in the Western financial order. Rule notes that gold has gained more than 50% in just 1 year, and could easily double again as the world migrates toward hard collateral and away from digital fiat illusions. He believes the US still has time to slow the collapse, but only if it allows market discipline to return. That means higher interest rates, lower spending growth, and genuine entitlement reform. We saw this once before, he recalls. The Reagan years didn't shrink government, but they slowed its growth enough for the private sector to catch up. That may be our best hope again. For investors, however, the path forward is clear. Rule says the combination of negative real interest rates, monetary inflation, and fiscal insanity will continue to drive gold, silver, and copper higher over the next decade as the dollar loses 75% of its value. Gold's nominal price could rise proportionally, potentially reaching almost $10,000 per ounce by the end of the decade. His advice is simple: hold real assets, avoid leverage, and be patient. The next great wealth transfer, he believes, will move from holders of paper to holders of tangibles. Gold isn't a trade, he reminds investors. It's insurance, and the fire has already started. So, as central banks print, deficits widen, and political manipulation infects monetary policy, Rick Rule's message echoes with urgency. The time for hedging against financial fantasy is over. The era of honest money has begun.